Imagine waking up one morning to find that the prices of everyday goods, your groceries, the latest tech gadgets, and even your gas, have skyrocketed. What if I told you that a major force behind this economic turbulence is the unraveling of one of the most critical trade relationships in modern history? The once massive economic bridge between the US and China is crumbling, sending shockwaves through global markets and threatening financial stability in ways few could have imagined. For decades, China has been America's largest trade partner, deeply intertwined with US agriculture, energy, and technology sectors. But in a dramatic shift, China has slashed $690 billion in imports from the US, shaking global supply chains and signaling a seismic power shift in international commerce. This move is more than just an economic dispute, it's a strategic realignment that could permanently reshape global trade, the rift that keeps growing. China's decision to cut US imports isn't a spur-of-the-moment retaliation. It's part of a calculated strategy fueled by rising geopolitical tensions, prolonged trade disputes, and a push for economic self-sufficiency. While Washington and Beijing have long engaged in a complex economic dance, the rhythm has changed drastically. This unraveling isn't just about tariffs and trade wars, it's about the global balance of power. For years, China was a key consumer of American agricultural products, semiconductors, and energy resources. But as trade conflicts intensify and both superpowers compete for dominance, the cracks in their relationship are widening, leaving industries, workers, and governments scrambling to adapt, losing a giant customer. China has pivoted away from American imports, redirecting its purchases to nations like Brazil, Russia, and key European markets. This shift puts an estimated $575 billion trade relationship at risk. The US and China together account for over 40% of global GDP, making their economic ties crucial to worldwide financial stability. But here's the catch. This isn't a new trend. Since 2018, US exports to China have been steadily declining. In 2023 alone, Chinese imports of American goods dropped by 17.7% compared to pre-trade war levels. For industries heavily reliant on Chinese demand, like agriculture and tech, this decline is devastating. According to the US Census Bureau, China's once dominant role as a buyer of American soybeans, chips, and liquefied natural gas, LNG, is fading fast. This departure isn't just a minor inconvenience. It's an existential crisis for sectors that built their business models around Chinese demand. From trade war to economic war. The US-China trade war, which began in 2018, was supposed to pressure China into buying more American goods. Instead, it did the opposite. The Trump administration imposed tariffs on $360 billion worth of Chinese products, prompting Beijing to retaliate with $110 billion in tariffs on US goods. What happened next was an economic shift that few anticipated. China didn't just retaliate, it restructured its entire trade approach. Beijing began aggressively diversifying its supply chains, forging stronger trade relationships with Brazil for soybeans, Europe for tech partnerships, and Russia for energy. According to economist Yending, writing for the Financial Times, the trade war didn't just provoke China, it accelerated its move towards self-reliance. The result? American products became more expensive and less competitive in the global market. US soybean prices alone fell by over 18% in 2018 as Chinese buyers shifted to Brazilian suppliers. Between 2018 and 2020, American farmers lost an estimated $4 billion in export revenue due to tariffs, forcing many to shut down operations. A crisis for American farmers and rural America. Few sectors have felt the impact of this trade war as harshly as American agriculture. China, once the largest buyer of US soybeans, corn, and pork, has significantly reduced its purchases. In 2022, China imported $36 billion worth of American agricultural products, down from $45 billion in 2017. By 2024, China's soybean imports from the US had plummeted by 18%. For farmers in the Midwest, this decline has been nothing short of catastrophic. Farm bankruptcies in states like Iowa and Nebraska surged by 23% at the peak of the trade war. According to the American Farm Bureau Federation, many family-owned farms, already operating on razor-thin margins, were forced to shut down. Losing China as a customer isn't just a revenue hit, it's a loss of stability, said John Heisdorfer, an Iowa soybean farmer and former president of the American Soybean Association. Export markets take years to build but can disappear overnight. Once you lose that buyer, it can take a decade to replace them. While American farmers struggle, Brazil has stepped in to claim the market. In 2022, Brazil exported a record 87.6 million metric tons of soybeans to China, capturing over half of the Chinese market. This wasn't just a coincidence. China actively invested in Brazilian infrastructure, building railways and ports to streamline the flow of agricultural goods. China's push for agricultural independence. China's strategy goes beyond merely replacing U.S. suppliers. It is actively working to reduce its reliance on American agricultural imports altogether. Key initiatives include approving genetically modified crops to boost domestic yields, implementing a national food security law to ensure self-sufficiency in staple grains, strengthening trade ties with other major agricultural producers like Brazil and Argentina. On August 5, 2019, China officially halted all purchases of U.S. agricultural products in response to tariffs. By 2023, its new policies had placed it in a far stronger position to withstand future economic conflicts. The Tech Cold War. Semiconductors on the front line. If agriculture is the first casualty, technology is the next battleground. Semiconductors, the backbone of modern technology, have become the focal point of an escalating economic conflict. In 2023, U.S. chip exports to China fell by 14%, a decline that is not just economic but strategic. China has declared technological independence a top priority. Its Made in China 2025 initiative aims to domestically produce 70% of its semiconductor needs by 2025. To achieve this, China has poured billions into research, development, and manufacturing. China sees its reliance on U.S. chips as a national security threat, explained Dan Wang, a tech analyst at Gavco Research. This is a long-term effort to reduce dependency, and American tech companies are already feeling the burn. Companies like Qualcomm have reported significant revenue losses due to reduced Chinese demand. In 2023 alone, Qualcomm's China revenue fell by over 15%, a number that could continue to grow if China's tech ambitions are realized. The bigger picture, a new economic order? What's happening now isn't just a trade dispute, it's the potential restructuring of the global economy. If the US and China fully decouple, the consequences could be unprecedented. Prices could rise, supply chains could be permanently disrupted, and the global economy could see an economic realignment not witnessed in decades. The evolving US-China trade war, a battle for economic supremacy. As the United States tightens export restrictions on advanced chip technologies to slow China's technological advancements, the unintended consequences of such policies are beginning to emerge. While these measures aim to curb Beijing's progress, they also serve as a catalyst for China to accelerate its own domestic innovation. Scott Kennedy, a senior advisor at the Center for Strategic and International Studies, points out that export controls are a double-edged sword. These restrictions might provide American companies with a temporary advantage, but they are also pushing China to redouble its efforts in achieving technological self-sufficiency. The shift in global energy security is another area where China has actively reduced its reliance on the United States. In 2021, the U.S. was one of China's top suppliers of liquefied natural gas, LNG. However, by 2023, those exports had plummeted by 25%. According to the U.S. Energy Information Administration. The decline coincided with China's deepening energy ties with Russia. Following the Russia-Ukraine conflict, China signed a 30-year agreement for natural gas imports through the Power of Siberia pipeline. Additionally, China has secured long-term LNG contracts with Qatar, including a $60 billion deal inked in early 2024. For American energy companies, the loss of Chinese demand has had significant financial repercussions. LNG export revenues dropped by 22% in 2023. Sending shockwaves across the broader energy sector. With China diversifying its energy partnerships, the U.S. faces increasing competition for global market share. China's growing trade alliances beyond energy. China is strengthening trade relationships with emerging markets, gradually reducing its dependence on the United States. Beijing's trade with Brazil surpassed $50 billion in 2023, making Brazil its largest trading partner in South America. In response, Jennifer Herman, a senior fellow at the Council on Foreign Relations, warned that, if the United States does not adapt, it risks being sidelined in the evolving global trade order. Meanwhile, the effects of past U.S. trade policies continue to unfold. The Trump administration's tariffs, initially designed to punish China, have had unintended consequences. While they aim to protect American industries, they also increased costs for consumers and strained relations with key allies. Higher prices on imported goods have the potential to curb consumer spending, disrupt supply chains, and contribute to inflationary pressures within the U.S. economy. Although President Trump has vowed to impose aggressive tariffs, such as a proposed 60% tariff on Chinese goods and a 10% levy on all other imports, economists speculate that he may introduce them gradually to mitigate economic disruptions. Some believe he may use tariffs as a bargaining tool rather than immediately implementing them. leveraging his well-known negotiation tactics. The fallout for American agriculture. One of the hardest-hit sectors in the ongoing trade war has been American agriculture. China's cancellation of soybean contracts with North Dakota is a prime example of the economic fallout. Once a major buyer of American crops, China has shifted its agricultural imports to Brazil and Argentina, leaving the $64 billion U.S. farming industry scrambling to find alternative markets. For many American farmers, the stakes have never been higher. John Heisdorfer, an Iowa soybean farmer, expressed frustration over the trade tensions. "We spent decades building these agricultural markets, and now they're being dismantled overnight. The uncertainty in the market is devastating." China's response to U.S. trade pressure has been strategic and long-term. By investing in alternative supply chains, approving genetically modified crop varieties, and implementing new food security laws, Beijing is actively working to ensure self-reliance. In 2024, China introduced its first food security law, mandating that central and provincial governments incorporate food security into economic development plans. This move underscores Beijing's commitment to reducing its dependence on American agriculture. The impact on U.S. agriculture has been profound. The U.S. Department of Agriculture projects a record $42.5 billion agricultural trade deficit in 2025, a dramatic reversal from America's traditional role as a leading agricultural exporter. Corn and soybean exports to China have plummeted by 71% and 33% respectively. Meanwhile, Brazil has capitalized on China's shift, now supplying 76% of China's soybean imports, up from 46% in 2016. The Semiconductor War. The semiconductor industry is another battleground in the U.S.-China economic rivalry. Leading American chipmakers, including Qualcomm, Micron, and Broadcom, have reported significant revenue losses due to reduced Chinese demand. While the U.S. government has introduced initiatives such as the CHIPS Act to boost domestic manufacturing, experts warn that adaptability and continuous innovation are crucial for maintaining America's technological edge. China, on the other hand, is rapidly advancing its semiconductor capabilities. Through initiatives like Made in China 2025, Beijing is investing heavily in domestic chip production to reduce reliance on American technology. The race for semiconductor dominance is intensifying, with both countries vying for control over this critical industry. The future of U.S.-China trade relations. As the trade war continues, both nations are prioritizing policies that align with their long-term economic goals. For the U.S., this means maintaining pressure on China while investing in domestic industries. For China, it involves accelerating self-sufficiency and solidifying relationships with emerging markets. The trajectory of U.S.-China relations will depend on whether the two nations can find common ground or remain locked in economic decoupling. The implications extend beyond trade. They influence global technology leadership, geopolitical stability, and economic growth. The fundamental question remains: can the U.S. successfully navigate this trade war while protecting its economic interests? Or will China's calculated strategies and expanding alliances ultimately tip the scales in its favor? The outcome will shape the global economy for decades to come.